Wall Street is working to absorb the latest round of geopolitical shocks, with U.S. equities showing notable resilience in the face of global turmoil. Even as energy prices and yields react to tensions abroad, domestic macro data is keeping the market anchored, setting the stage for our March 2026 strategy. The recent volatility was kicked off by a sharp move in both energy and rates. According to The Compound, Brent crude jumped about 8% in a single day, a spike that is bringing inflation concerns back into focus. We are seeing a similar move in fixed income, where the 10-year Treasury yield climbed to 4.10%, up from below 4% late last week. The recent volatility was triggered by a significant move in both energy and interest rates. The Compound notes that Brent crude surged about 8% in a single day, a move that's brought inflation concerns back to the forefront. At the same time, the U.S. 10-year yield saw a sharp climb, rising from under 4% on Friday to roughly 4.1% by Tuesday. This energy shock hasn't hit every market with the same intensity. While the U.S. continues to show internal macro resilience, highlighted by a 63,000 ADP jobs beat and a robust 56.1 ISM services reading, Europe is feeling the pressure much more directly. Eurodollar University highlights a rare unsolicited warning from the Swiss National Bank, which is now prepared to intervene in currency markets to curb the rapid rise of the Swiss franc. They argue that if global growth expectations continue to weaken, the SNB could even be forced back toward negative interest rates. The Compound observes that European assets are under much more pressure than U.S. markets, and you can see that divergence in the capital flows. We're seeing record-breaking cash deployment here at home, with $328 billion in ETF inflows recorded before February even ended, tracking 64% ahead of last year's pace. While some fear the oil spike is inflationary, Eurodollar University suggests these geopolitical surges can actually be disinflationary by destroying demand, a trend that's already prompting rare intervention warnings from the Swiss National Bank. While many focus on the oil spike as an inflationary threat, Eurodollar University argues these geopolitical price jumps can actually be disinflationary by stifling global demand. This creates a difficult balancing act for central banks, particularly in Europe. The Swiss National Bank has already issued a rare, unsolicited warning that it stands ready to intervene in currency markets to stop the Swiss franc from rising too fast. If global growth expectations continue to weaken, analysts suggest the SNB could even be forced to push rates back into negative territory to protect their export economy. There is a paradox in how the market processes these oil spikes. While the common fear is that rising energy costs fuel persistent inflation, Eurodollar University argues that rapid surges actually destroy demand. This is ultimately disinflationary. They suggest this dynamic could eventually force the Swiss central bank back toward negative interest rates if global growth continues to weaken. Amazon is seeing a similar trend. Its recent free cash flow dip is tied to heavy investment spending, but Joseph Carlson views this as a timing issue rather than a fundamental decline. While that high Capex makes current multiples look expensive today, the underlying earnings power is the real story. According to his framework, if Amazon hits its growth targets, it could potentially deliver around 20% annual returns over a 5-year horizon. Aswath Damodaran is calling for a reality check on the AI disruption narrative. While survey data shows that usage is rising steadily, he points out that growth hasn't actually turned exponential just yet. His analysis suggests that the displacement we see across global industries will likely be much more gradual than the initial hype led many to believe. Semiconductors are hitting a wall of supply near the 405 range, where anchored resistance and the 20-day moving average converge. On a more positive note, biotech could show some leadership if the XBI holds 125 and forms a higher low. And we're already seeing a rebound in Korea ETFs like the EWY. Even so, Alpha Trends notes the broader index structure is still facing pressure from declining averages. Until that shifts, it's best to stay disciplined with smaller sizing and lower expectations. One key item on our tactical watch list is mega cap Capex efficiency. For instance, Amazon's recent free cash flow dips are driven by heavy investment spending rather than a fundamental decline in the business. According to Joseph Carlson's analysis, if growth targets are met, this underlying earnings power could still support robust returns, potentially 20% annually over a 5-year horizon. With the market trending in a range between 6750 and 6900, Alpha Trends is favoring smaller position sizing rather than chasing breakouts. We're keeping a close watch on these technical battlegrounds, specifically the 405 resistance in semiconductors and the 125 support for biotech. Along with those levels, we're monitoring the 10-year yield at 4.1% and MSFT Capex efficiency to see how they impact the broader tape. While U.S. fundamentals anchored the market today, we're still navigating a low-conviction environment. Tactical discipline remains the priority, with the index likely to hold a potential swing range between 6750 and 6900. We're watching the 10-year yield at 4.1%, MSFT Capex efficiency, and semiconductor resistance at 404 for the next signal. You can find the full list of sources and citations in the description. If you found this recap helpful, please subscribe for daily updates. We'll see you tomorrow.